New data released by the Japanese government shows that the nation's wages, adjusted for inflation, have fallen for a full year as pay increases fail to keep up with rising prices. The prolonged erosion of income is raising serious concerns about consumption and the future direction of one of the world's largest economies. Japan's Labor Ministry data shows real wages, or the wages adjusted for price changes, fell again in December last year, extending a losing streak through all of last year. Although the total cash earnings or nominal wages increased around 2.4% year on year, inflation remained strong enough to keep incomes in negative territory. Base salaries climbed roughly 2.2% and the bonus payments also edged higher, but those were insufficient to reverse the year-long slide in inflation-adjusted pay. For the full year, real wages dropped by roughly 1.3% in 2025, marking the fourth consecutive annual decline since inflation began outpacing wage growth after 2022. For families, this means less room to spend. Domestic household consumption, which accounts for more than half of Japan's GDP, has remained weak as consumers prioritize essentials and dip into savings to cope with higher prices. This is a major problem for an economy already struggling with a shrinking population, aging demographics, and decades of slow growth. Despite periodic upticks in activity, underlying demand remains fragile, and economists are warning that Japan's economic recovery is losing momentum. Japanese labor groups are pushing harder for higher wages as households struggle against rising prices. The Japan Federation of Basic Industry Workers Unions has initiated this year's Shunto spring wage talks by demanding a monthly pay hike of 15,000 yen, matching last year's record high claim. Union leaders say this level of increase is necessary to sustain wage growth exceeding inflation, reflecting frustration that real wages have failed to keep up with the cost of living, even as nominal pay rises slowly. The BOJ had also begun to move away from ultra-loose policy by raising its policy rate to 0.75%, the highest in around 30 years. In December 2025, BOJ officials signal a willingness to hike further if conditions warrant. Officials have stressed the need for sustained wage growth to underpin inflation near the target without undermining demand. With real wages still falling, the central bank risks tightening too fast and hurting demand, or moving too slow and allowing inflation to keep eroding incomes. Political pressure is now building on Japan's newly re-elected Prime Minister Sanai Takaichi. After a decisive election win, Takaichi has promised measures to support households and revive consumption, including tax relief and fiscal support. But with Japan's debt already among the highest in the world, any big spending push risks spooking bond markets and clashing with BOJ policies. As real wages continue to slide and consumer spending weakens, Japan's economy is losing momentum, putting the Bank of Japan and the new government under growing pressure to deliver.